Okay, so yeah, just little title page here. Okay, so why would we use a hard money loan? I have a few bullet points, I'm going to talk a little bit further, but we use a hard money loan mostly to leverage the amount of money you have to invest right now, your current savings. If you're using a retirement savings, liquidating a stock portfolio, if you have savings, whatever it may be, um, that's why we would use one, because you can take $30,000 and then basically double it on a project, if not more. So that's why you would use a hard money loan to facilitate that project. Otherwise, it's difficult to buy real estate to fund renovations with your $30,000. It's near impossible without using additional funds. Hard money loan also, you would use it to buy a property that needs work. To get a conventional investment loan, the property needs to have the utilities on. It has to also be livable, technically speaking, as approved by the appraiser, and then secondarily the lender, the underwriting team, or they won't want to lend on it. So that would cause you to seek other options, and one of those is a hard money loan. To do so, like I said on here, fixer-uppers don't qualify for conventional loans. They don't qualify for FHA unless you do a 203k, whole different story, but typical FHA. And so that's really why you would use a hard money loan. Also, sometimes conventional loans require you to have 25%. I've been seeing some lenders really prefer 25% recently. So with most hard money loans, most hard money loans are going to only require 10% of the purchase price. So it's cut in half. And then it does have higher fees. So you may effectively be coming out of pocket 15 to 17.5%. But that's still below the 20%, 25% plus those fees, which aren't as much, but already you're beating that. Another reason is because you need to move quickly. Conventional loans, they take 30, 45 days to close. And hard money loans can close in a week, 2 weeks. Once you're approved, all you have to do is essentially get a property under contract. And then you can close it almost as soon as you do your inspections, if you're choosing to do so. Sometimes they need an appraisal, but they can do pretty quick appraisals. And sometimes they can do in-house appraisals or BPOs, which is a broker price opinion, which isn't a full appraisal, but someone with a broker's license or someone within their office would put together comps, like we've been talking about, how we find our after repair values, to see how much money the property is going to be worth after you fix it up. We'll dive deeper into that later on. But these are the reasons why you would use a hard money loan. And it's effectively cash when you're buying. As a buyer, you turn into a cash buyer when you have a hard money loan. So you can, you can offer much lower because you're going to be able to be a cash buyer in the seller's eyes. So there's just a few reasons. There may be more, but these are the main ones why you would want to do a hard money loan. So how to find a hard money lender? I have three. One that I've extensively worked with, and the other two who I've been heavily referred to by other investors and other brokers who work with investors. Carolina Hard Money is who I use, and they lend in the Carolinas and Virginia, and they're slowly expanding as they grow. When I first started with them a couple years ago, they were only in Virginia, North Carolina, and South Carolina. So that's Carolina Hard Money. Have a great relationship with them. They give fair terms. Link Capital, have a great relationship with the loan officer. She's very kind and has treated my clients very well. They've ended up going with other lenders, but they still are very good. So, and then Longhorn Investments, they're national. And they have regional offices, and countless investors use them. So those are the three that I recommend. Another one is a broker referral, right? It's like I'm giving these referrals. If you're working with a broker in another market, or you don't want to use one of these lenders, ask your broker who they work with, because sometimes if they have a relationship, then they're going to be able to have much more efficient communication with a pre-existing relationship than maybe someone brand new. Not to discourage you to use someone they don't know. You can use who you like, but sometimes it helps, and sometimes they know someone with great terms that they offer that broker's specific clients because they trust that broker. Hard money lending is a lot about trust and trust building, and relationships, as all real estate is, but especially on the lending side. So we'll dive deeper into that as well. Bigger Pockets, I linked it here, and I'll send you guys this presentation too. But Bigger Pockets is a great real estate resource website, and they have an entire investor-friendly lender page. And I have called hundreds of lenders off of this. But basically, you go down to your state where you want to do it, and they have all sorts of lenders available. But let's say fix and flip. They're not going to say hard money specifically. You're going to put the type of project you want in. Sorry, my screen's over there, but I need a point here. You're going to put the type of project that you want to do. Am I sharing it? Yeah. Okay. And let's say fix and flip. Then you find a lender. And okay, no specific property. You go through this. When are you hoping to purchase? Basically immediately. Let's say target purchase price is 125 because that's what my example is. Max available funds. Let's say 10%. Boom. Okay. We'll just start with 0 if you're at 0, and kind of a medium credit score per se. The higher your credit score, just with any type of loan, the better you're going to get. So on here, let me just move it over here. Sorry, guys. Actually, no. On here, you're going to have a list, and you can just start contacting them. This is okay. So this fits what they've matched. Anyways, you can go on here, contact these people. And you just keep putting different criteria in different states, wherever you're doing, and it'll come up with great lenders. Just another outlet. Another one is Facebook groups, real estate Facebook groups. If you're an investing group, people post there all the time. I'm not going to speak on the legitimacy of their, lending businesses, but again, it's about trust, it's about relationships, and have a conversation with them. See if they have a website. Sometimes it's just an individual who may have a HELOC, who may have just a bunch of cash sitting around that they lend out. It also may be an individual to business. So there's different avenues, and then just a simple Google search and reading reviews, looking up terms are all ways you can find a hard money lender. The application process. So the application process is going to be fairly straightforward. There's not a whole lot that they need in comparison to a conventional loan that goes through thorough and rigorous underwriting. They really dive into all your financials. This is just going to be a simple application that you do on their website. And then you're going to have to upload documents as well. Each lender will have different requirements, but some typical ones are income verification. They want to know if you have a job, just type of income to support, since they are going to be lending you, $100,000 plus. Potential bank statements just to prove that you have the down payment available and or the reserves, because they require you at times to have reserves as well. And then your driver's license for identification, your LLC documentation. So most hard money lenders, I would say also, they'll only lend to an LLC, some type of corporate entity. Typically LLC is most common. So they're going to need that as well. And then sometimes they'll need also an asset information sheet. So the assets that you have and own, that way they know you're a strong borrower. They're not just giving money to someone basically with no money, no assets. Again, this depends on the lender. Some are more stringent than others. Find what fits you and move forward with them. You also have to approve a hard credit pull. I mean, they want to see your full credit report. And a common misconception is that it's bad to get a credit pull. It's really not. And if you're going to be a real estate investor, you need to understand that hard credit pulls should just roll right off your shoulder, because 10 to 15 point hit from I think it's honestly maximum 10% that, or 10 points that can get hit for a mortgage inquiry. And so your credit will drop momentarily, but 1, 2 months later, it'll go right back up. The credit bureaus know if you're looking to get a mortgage slash loan, and in the short term, it's well worth the hard credit pull. Additionally, getting an additional credit line on your credit report, if it goes there, then that's also something that can help you on the long term. Having a credit line, showing it, active. But with Carolina Hard Money and most of these that use LLCs, it's not going to show up on your personal credit report. Even if you default, even if you go into foreclosure, it's not going to show up. What the implications will be is how they recoup their funds. So that's different for everyone. Some of them just take the property back. This is worst case scenario, but I'm letting you know. Some of them just take the property back. Some of them take the property back and want some funds. Again, that's a question to ask your hard money lender. As far as Carolina Hard Money goes, I know that they just take the property back essentially, and it doesn't go on your personal credit report. Then you have to also not to get approved, but to approve a specific property is submit that property, or generally submit a prospective property. That way they know what you're looking for, and if you're even going down the right track, if there's someone you want to work with. So that would include the property address, your estimate of the ARV after repair value, from pulling comps yourself in the area of renovated and recently sold properties, typically within the last 3 to 6 months. And then also the market rent for that area. Whether you're fixing and flipping, they also want to know for the security of the loan, how much that property could get rented out for. So whatever the market rent is for that specific area and that specific property. Some things to consider about hard money loans and just to know is that they're short term. They want to lend you the money, make some money, and get their money back so they can do it again. The loans are typically short term, 6 months, 9 months, or a year. And this is good, honestly, in what I believe, to keep you on track with your project, not to be able to get a project, start spending a bunch of money in carrying costs and renovation, and then let things drag out. This is also an encourager to stay on your project, to move it along, and figure out how to complete it. It's also just another form of accountability on the investor side. You must refinance or pay off the loan by the end of the term. If you're fixing and flipping, that means selling the property and paying off the loan at closing. If you are refinancing, if you're doing a BRRR, that means finishing the rehab, getting it rented out, and refinancing it. Another way that you could get out of this loan is by taking on a partner who wants to invest in the property. It also could be a few different ways, but really those are the top three. The third one I just mentioned. Renovation costs also are able to be included in the loan. So I have an example I'll show you next, and the renovation costs are included. However, there's a caveat. Those funds are escrowed and they're held in an account for you. They're dedicated to you, but you have to do the work and then submit an approval, submit a draw request. They'll send out an inspector, and then once that inspector comes out, approves the work completed that you submitted on your draw, then they will tell the lender will approve and wire you the funds. Typically, the time frame from a draw request until the funds hit your account is 72 to 4 days, 96 hours, I believe, something like that. 3 to 4 days, we'll put it that way. Business days. So you want to note that. And when you submit a property and you take it under a hard money loan, up front, you have to submit a scope of work. So you need to have an entire scope of work laid out, the costs of the labor and the materials, and that is what they're going to base the draw requests on. So if you put that your floors, you're going to replace all the floors, and it's $7,000, but your invoice ends up being $8,000, they're still only going to release $7,000. So I recommend putting numbers above what you expect, just slightly for protection. But if the floors only come in at $5,000, then they're still going to release that seven. And I would recommend that you don't just like play with that money. You're paying for it, so apply it to the project. And then at the end of the project, if you don't use all your renovation money, and you don't request it all in draws, because again, you had a $2,000 surplus on floors, you applied it to some of the renovation, and you did not draw later on down the line because you've completed your project, then that money is not going to have to be repaid. So I'll teach you in the next example. Another thing to consider is that the monthly payment is usually interest only. Does not include your property taxes, does not include your insurance payments or your utilities. Most that I've seen also do not include principal every month. So you're not paying down on the value of your property. You're just paying them to essentially have facilitated the purchase, facilitate the renovations, and hold this property until you can refinance or sell it. All right. So some loan related costs are going to be your application fees. Varies by lender. I've seen $250. I've seen $1,000. The origination fees, which is essentially just their payment to originate the loan, to create the loan, is 2 to 4 points. Points is another word for percentage of the loan. So yeah, just take a note whenever someone's talking about points, 1 point equals 1%. Documentation fees can be $250 to $1,000. Again, it varies. If it's higher, maybe find another lender or figure out where they're making up the money. They may have a lower origination fee and higher application documentation fees. So that's just something to note and to assess as you're picking a lender. The interest rates typically range between 9.99%, 10 effectively, and 13.99, 14%, right? So you want to judge, your lender on that. And the monthly payment is going to be interest only. So that's another loan related cost. Draw fees are between $200 and $300 per draw. So when you submit a draw, again, for that $7,000, you're actually going to get, if it's a $300 draw fee, you're going to get $6,700, right? They're going to take that $300 out. You don't pay that out of pocket. They just deduct it from your draw. And then let's say you have a 6-month or 9-month, let's just say 6-month loan, but you're at the 6-month mark, your project's not done, maybe your refinance isn't closed, or your property's under contract and hasn't sold, one thing or the other. They typically charge a 1% extension fee of the total loan. So I'll show you on the next line. We're going to do an example. So for example, let's say your purchase price of your property is $125,000 and your renovation is $40,000. Well, with a 10% down payment, which is $12,500 on the purchase price, you want to note that your down payment is going to be only based off of your purchase price, not your purchase price plus your loan. The loan is usually 100% covered in the loan. So your total loan is going to be $152,000, $152,500, right? Your application fee in this example is $500. At 3% origination, you're paying them $4,575 just to create the loan for you. Another $500 in doc fees. If they require an appraisal, I added $750. Appraisals are expensive nowadays. They vary by market. I've seen them be $900 and I've seen them be $450. But I put $750 kind of to be in the middle. Your total loan closing cost is going to be $6,325. So you add that with your 10% down payment and some other fees. If you're, closing with an attorney, they're going to have fees, county recording fees, things like that. But this is loan specific. Your loan specific fees at closing are going to be 10% plus $6,325. Then you have the property. Your interest rate is 11.99. So your monthly payment is going to be $13.97 and change. I got this by multiplying 152.5 by 11.99. That gives you the annual 12-month interest on the payment. You divide that by 12, and that is your monthly interest only payment to your lender. Any draw that you take out, let's say on this project you take 8 draws, that's at $250 a draw. You're paying them $2,000 for those draws. And then let's say you have to go over because you have a 6-month and you really need 9 months or whatever, 7, 8. You would pay them $1,525. So those are fees associated with it, and that's pretty much all I got for today. So that's a quick rundown on hard money loans, how to find them, what the fees look like, why you would use them, and I'd be happy to answer any questions y'all have.
I have a question. Hard money loans, would they be ideal in the place of like a FHA 203K?
They certainly could serve well. They would allow you to buy a property that you're doing the same thing, right? You are buying a property that needs work, hopefully extensive work to get the most value created. 203K would have lower fees, but it would also take longer and have a lot more hurdles to jump through. It definitely has its benefits because 3.5% down payment versus 10. And I believe it would have lower fees overall than the hard money loan, charging you interest only. FHA, you're paying down your principal every month. Also, your payment is covering your taxes and your insurance. So there are definitely benefits and drawbacks, but they could be used for the same type of property.
Makes sense.
Mm-hmm.
Follow up. Would that be the same as like what was I'm thinking? Owner finance? Like, would it go against, like, say someone like a first time home buyer and they did their first one with a hard money loan for a rehab? Would that count? Quote
No.
unquote?
No. So let's say you didn't have a primary residence, or you still qualify for a first-time homebuyer loan, and you did a hard money project. It would not count you out. You could buy hard money. You could utilize a hard money loan for an investment property and still get an FHA loan, a first-time homebuyer loan, on another property.
Nice.
Yeah.
And
One
to
thing-
confirm again, sorry.
Yeah.
Hard money is ideally to be used, right, for BRRR or fix and flip, correct?
Correct. Yeah.
Okay, thank you.
You could use it for a buy and hold property, to move quickly, to buy as cash, and then essentially refinance pretty quickly after that, just to secure it. Because sometimes great deals come by and the opportunity cost is worth using a hard money loan. But also sometimes just being patient and not paying those additional costs could work out for you. Yeah. Another thing to note, because you guys are asking about like FHA versus hard money. Hard money, like I said, is only going to be for usually lent to an LLC. And if the LLC owns it, I haven't tried this. You could potentially buy it from your LLC with an FHA loan. That's just getting really creative and kind of like working the system. I'm not sure the legality behind it, but it could work that way. I'll definitely look more into it.
So,
but yeah. Go ahead.
So hard money lender will only lend money to an LLC, you said?
Most of them.
Most often, yeah.
Gotcha. So then is it that for every house you purchase, you have an LLC, or is it one LLC that purchases all your houses?
Yeah, great question on like legal setup for your business. In the beginning, you definitely want to have one LLC. That way everything is lined up until your portfolio gets big enough. Some and everybody's going to give you a different answer, whether it's an accountant, an attorney, or another investor. One way that what I recommend, honestly, to save a lot of money, because holding multiple LLCs creates a lot of annual filing fees, tax returns you have to file. And if you're paying a CPA, that could really add up. Bank accounts you have to open, things like that. So having 5 LLCs for 5 properties, I wouldn't recommend. I would recommend one LLC. What I do is by state and by partner. So I have 3 LLCs in North Carolina because I have 3 different partners. But within those, I have 5 properties. I have 2 properties. I had 8. Now I'm at 4 in another one. So that's how I separate it. And then, like in Virginia, I have an LLC with a partner. And although it is the same partner as I have in North Carolina, but because it's in Virginia, I like to hold my LLC there with those properties to just stay in line with laws and regulations, everything. If there's ever a lawsuit, we're not kind of crossing state lines. I haven't worked with like legal setup attorneys to really strategize that in full. This is just basically what I've known and I've learned through my conversations with them. I'm not at a high enough level yet to do that. I know people pay like $15,000 to $20,000 to get a crazy setup, but yeah, I have that LLC in Virginia with a same partner as North Carolina, and we have a few properties in there too. So to answer your question, the goal is to have a really great insurance policy, because if you get sued one way or the other, your insurance is what you're going to defer to pay that out, which is why you have business liability insurance. If you have a really great policy for your properties and then also for your business, your LLC, then you should be covered. No use in spending all the additional fees separating it out.
Gotcha. Thank you.
Yeah.
There was another thing you screenshotted. You found it?
I couldn't find it. I know it's not in the realm of hard money loans, but I know I saw I don't know if you heard how they came out with like a new FHA product that is is it 0 money down, up to 4 units? I think it's like under Fannie Mae or Freddie Mac.
Yes. Yeah, great to bring that up. So there's a new they just this month, I think, or late September, updated the rules for 1 to 4 units. It's quite confusing to me, because in the markets I've worked in, Texas and North Carolina, 1 to 4 units is considered residential, but potentially as an investment. I need to look deeper into it, but it's 5% down. They've lowered it from 20% down to 5% on conventional loans. It's no different on FHA. There's 3.5, still across the board, but it's for conventional loans. In Virginia, if you go anything above 1 unit, like 2 to 4, is considered commercial. So in a market like that, I feel this update is more applicable. But I would definitely need to do more research on it. I'll write that down.
All right, we've hogged all the questions. Mike, it's your turn.
No, y'all are good.
No, y'all are good. These are great questions. I had one about hard money lending, and Dimitri, it sounded like you could potentially try to attain a hard money loan for like a potential investment. Like maybe you don't have one specifically in mind or a specific project, but you might be able to hey, this is like what I'm projecting or looking at. Was that accurate? Did I interpret that right?
Yeah, absolutely. I think some lenders are going to want to know potential properties that you're looking at, or even an example of what you would go for. Sometimes they can already be sold, and you say, "Hey, I was looking at this property, went under contract, is sold. Now I'm ready to jump into the game. This is what I would have. This is the property I would have purchased, what I would have done, and this is how it turned out. X, Y, Z." You can do that too. They'll want that. and that's going to be a good way to get approved. This way you can also, here's another misconception about hard money lenders, that they're just out to take your money. Not true if you work with the right ones. Carolina hard money, they actually have like we're doing right now, kind of coaching calls. They have those available too for their clients, because they want their clients to be successful. They only make money if you're successful. If they have to take all these properties back because the people they're lending to are not successful, then that's not a good business model. They want you to do a good project, pay them back, and use them again. So they're happy to answer any questions, give advice. Now, they're not there to hold your hand while you walk through it, like I am, but they're definitely a resource to utilize as well.
Sweet, dude. Yeah, that's great perspective. Yeah, definitely like like you kind of said at the beginning, you know, just the name of that loan type, it made me nervous coming in, right? Like I've always been kind of wary of it, but definitely done well to demystify some of those myths. So a follow-up question on like a prospective approval for a hard money loan. Say you get approved for, call it $100,000 for this prospective project that you fix and flip project that you want to do.
Yeah.
First question is, are there any, so the first piece is like the term of the loan, right? So you said typically like 6 to 12 months. So does that come into effect? Like say it takes me 3 months to buy a property. Mm-hmm. Is that already 3 months into my loan term and I'm already making interest payments? Or is it like, once I'm ready to like actually spend the funds, that's when the term starts and I'm actually drawing those funds from the loan?
Yeah. So as soon as you close on the property is when you start paying them. Okay. If you want to decide to sit there for 3 months, essentially waste your time, then like that's on you to pay the interest. There may be an instance where you buy a property that has a tenant that you need to move out in order to do the work. I've been in that position too before. Either their lease is ending and you're required to honor it for 2 months into the loan, 3 months into the loan, or it's a holdover tenant essentially who was not removed at closing and you have to evict now that you're the new owner. Not a great situation. I recommend you negotiate, you hold out closing until that tenant is moved out, unless they're on a lease. But otherwise, you would want to get started immediately, but upon approval, you don't start paying. Only upon closing.
Okay.
Yeah. And if you also, on the other hand, let's say you finish your project, the rehab is only 1 month, you put on the market the next month, and it's month 3, you've closed the deal and they're paid off. You just save yourself all that money that you would have paid in interest-only payments, right? So the faster you do a project, the less money you end up paying them.
Yeah.
Mm-hmm.
Cool. That's helpful. Yeah, does it make sense for like, if it's advantageous to, like if we're in the market trying to look for properties to fix and flip or BRRRR, if it's advantageous to like get a jump and basically like get a pre-approval or like an approval for a project, right, that we don't have yet, or if it might be better to like have something specific in mind and then you can like be like, okay, this is actually what my costs I'm projecting them to be. So maybe you can speak on that, or like if my project ends up being, I have like different types of expenses, right, that still fit within this approval, like, is that an issue? Can you make like tweaks to it, or
For sure. Yeah, no, off the bat, I recommend absolutely, if you're serious about investing, get pre-approved. Get that pre-approval. That way, you can pull a trigger. That way, you can start investing.
Yeah.
Something I do want to touch on is if you, let's say $100,000 is what you get approved for with a $40,000 budget. Well, let's say that property doesn't work out and this new property is $50,000 with $150,000 with a $50,000 budget. Well, that's really not a problem in the hard money world. You can resubmit that property because they're looking at the property numbers. They're not solely looking at how you can support the loan, because they're expecting you not, if you had all the cash, you probably would be using it or using a different method. And also, basically, like, they're going off the property. So something I didn't mention, which is, thank you for bringing this up. Your approval is based off of the ARV. So if your ARV, I'll do some math real quick. If your ARV is $250,000, okay, they'll loan you up to, that's too high. Let's say 200 times 0.75. Okay. The ARV, when it's all said and done, fixed up and everything, ready for the market, is $200,000. Well, the hard money lender will loan you up to $150,000. That is combined purchase price and renovation. Now, you're going to pay your 10% down on the purchase price, so you have a little bit more space for your renovation there. But they're mainly concerned about those numbers, because if you do that project right, you're going to still have a 25% margin. So it's a safe bet for them. The implications on going higher are they need to make sure you have the down payment, as do you, and the reserves to hold an increased monthly interest payment. Those are the implications. But if you find a property that works that's higher or lower, just let them know and get it revised, basically reapproved. They're going to be able to do that very quickly, because they have your credit, they have your everything, right? Your reserve accounts, things like that. So that's another thing I wanted to mention. Yeah.
Question.
Nice one.
Yeah.
Just like kind of like a follow-up to that to make sure I'm understanding correctly.
Please.
So when you purchase a property, right, you've closed on the property, the only overhead cost you have is the interest only payment to the hard money lender, because technically on a like new loan or home purchase, you have 2 months, right? 60 days before your first mortgage payment is due. Am I thinking about this correctly? So it's like I buy a house, I got my hard money loan, I'm fixing it up, right? So ideally, if I can knock it out in 30 days, I made one interest only payment. I didn't pay, air quote, any mortgage. I refinanced, got a new note. My tenants pay my mortgage, and I really only came out of pocket, air quote, the interest only payment to that hard money lender that one time, plus the fees on the new mortgage.
Pretty much, yeah.
Okay.
Yeah, being speedy is definitely like beneficial. So, and your question of, do you pay like 30 days after, 60 days after, it depends on the day of the month that you close. I'd say also your out-of-pocket cost is going to be utilities and your insurance. You're going to need to have those. And when you're doing when you're doing a renovation project, the insurance policy you're going to get is called a builder's risk policy. And that is just going to cover you in the time that you're doing renovations on the property. Builder's risk properties also oftentimes are not ideal when you have a tenant. There's different coverages, but the utilities, the insurance, and the interest-only payments are going to be your holding costs. Yeah. If you're at the end of the year when taxes are due, you may need to consider that as well, a tax payment. But if not, if let's say you're doing spring, summertime, or taxes were paid by the seller at closing, it's going to be prorated out. But let's say you're at the end of the year, taxes are due, the seller just paid, then you won't have that payment. If you're in the spring, summertime and taxes aren't due till the end of the year, it would be smart to put them aside, but it's not like the tax collector's knocking down your door. If you're refinancing or selling, then those are also going to be prorated at closing. You don't need to pay them out of pocket.
Gotcha.
Did that help?
Yes.
Cool.
And for these hard money loans and 2 or 3K, the contractor or buyer is upfronting the repair costs until we can draw the money from the escrow.
So for sure on the hard money loan, on the FHA 203K, I still need to learn more about it. I think both the lender and the contractor kind of play into that. Whether the lender will provide deposits for the contractor, or if they require the contractor to, which I think is the case for 203K, they require the contractor to do the work and then get paid. And if it's a contractor who's familiar with 203K, then they know what they're signing up for. In other cases, they may require deposits up front. And in this market environment with materials being so high, it's very common for contractors to require anywhere between 40 to 60% as a deposit. And that's something for you to work out. Some of them are flexible, some of them are not. And that's something you want to talk about with your contractor as well. Yeah.
Yeah. And one great thing about that, which I'm assuming, a hard money loan won't require the same kind of contract that 203K requires.
Right. Yeah. So 203K, I believe, would require a licensed general contractor. Hard money loan, I mean, some people do DIY with hard money loans. Sometimes they basically are the general contractor themselves, hiring the roofer, the plumber, the electrician, the carpenters, things like that, which is kind of how I teach. It saves you money for sure. And or there's crews. So essentially in North Carolina, if you do jobs under 30,000, and there's ways to even expand that through multiple invoices and multiple projects per se on the same property, you're not required to have a general contractor's license. So you can work with a handyman slash contracting company that doesn't have their GC license for these projects as well. It's very flexible in the hard money world. They really just want you to get it done.
We have learned a lot.
Yeah, good. Awesome. Yeah, I'm happy to answer any new questions as well. Follow up if you think of any. We have 13 minutes left. If you'd like to ask more, I know also this is a pretty straightforward night. So
Questions. So when
Yeah.
we're going to a hard money lender, are we like kind of putting together like the same level of documentations that you would for a typical mortgage lender? Or is it just what you had showed on the screen where it's just like, all right, this is the property purchase price, ARV, scope of work, and this is how much I need type of thing?
Pretty much, yeah. And if you have good credit, that helps a lot as well. You're not going through an underwriting process as you would with FHA or conventional loans. Those are very stringent, and that's a benefit of the hard money loans. They care about the property specifically because that's what their collateral is. Sure, in the other loans, that's their collateral as well. But hard money lenders are in the business of real estate, in the business of fixing flip properties. So they care more about the property, and as long as you kind of meet their requirements, whether that be a 640 credit score, $15,000. Typically it's like a 6-month reserves of the interest payment. They want to see that you have available, and then the 10% down payment. That's pretty much it.
And you said that 6-month reserve, right? Like you can show proof of that through like investment accounts. Is that what you said?
That's
Okay, so if you have, that much in your 401k, then that's good. Also, would hard money loans be good to use to purchase foreclosures?
Oh yeah.
Yeah, absolutely, for sure. That because you're a cash buyer there. Foreclosures, you can't buy them any other way. Well, you could, but again, the process is longer. So being an aggressive buyer who's prepared definitely comes through having a hard money loan.
But would that be? But you wouldn't be able to use. Well, I guess you could, but would you be able to use hard money loans like at like an auction type situation, or would it be a little more traditional foreclosure through a, you know,
HUD.com.
agent or HUD.com type of scenario?
You still could use them in an auction, because what you would have, you could also ask, you could tell your lender, hey, I'm going to be buying foreclosures. I need a proof of funds for $150,000. Well, they'll give you a sheet that gives you those proof of funds, and you can go under contract, and then boom, there you have it. You have your funds available. You pass that along to the lender. In that scenario, you would really want to know the numbers. You would want to be confident in the renovation and the purchase price, and then because once you're under contract, that giving a proof of funds may be a little bit more difficult to get out of.
Yeah.
Okay. But absolutely, you could use it.
Perfect.
Yeah. And this would be a loan to use on a lot of those properties I showed you guys on the last call. How to pick and select fix and flip and BRRRR properties. So also, yeah, foreclosure properties, off-market properties, that maybe you connect with a seller or you hear from word of mouth. All these ways are definitely, all these types of properties are definitely good applications for a hard money loan.
Yeah, but had that stigma.
Yeah, for sure.
Yeah, that name is very hard. That's aggressive name.
Right?
Hard money. It's like, well, sheesh, is there soft money? Like what?
Yeah, and I didn't want to like confuse you guys, but now that we've been through all of it, sometimes hard money is interchangeably called private money, because these aren't big bank institutions. Oftentimes, these are smaller businesses with access to investors, potentially investors themselves who, like I said, you build that relationship with, or who will invest or who will provide those funds. At one of the real estate meetups, at a few of them, I've met people there who are investors who also lend money, where Carolina hard money, that's like their business. But if you meet an investor at a real estate meetup, one of the guys I talked to, he said, I do 12% interest, 2% origination, no application fees, no doc fees. I need to know your credit score, the type of property, your reserves, and we can do business. So that would be definitely private money. It's not like a hard money institution. But those words are used interchangeably. Hard money is just the most popularly known and I guess technical term for these loans and these projects, but interchangeable private money. And, if you build a relationship, maybe you can find someone like that who offers great terms. Yeah, it would be so hard money. Like I said, I'm talking about institutions, but the private side, right? It'd be no different than you finding a project and finding someone potentially within your network who has 200,000 just sitting there, or maybe in the market, and they see the market going down. Hey, I have this project. Lend me the money. I'll pay you. If you could say 7-8% interest, whatever you guys can agree on. You can also offer no points to be advantageous for yourself. You can, typical is interest only payments. You set up the term. Doing a loan like that is definitely, in most cases, going to be more cost effective for you. It's just about finding those people who are able to lend that type of money.
Gotcha. And that notion of points, like, is there no way around that?
No, not with a institution type hard money lender. Like I said, with a private lender, maybe you could work it out where there's no points. Maybe they give you a 14-15% interest rate, but you don't have to pay any points up front. So as you analyze the lenders, you're going to want to know their application and documentation fees, 1 and 2, their points, their interest rate, their draw fees, and then their extension fees. That's the totality of really what you need to know.
And points, is that just like is that the word for interest rate, or what is points exactly?
Yeah, points is interchangeable with percentage. That's just what they say. So in order to originate and create this loan, they're going to charge you 2% of the loan cost. That is like just the fee you pay them. The technical term in the industry is points, though.
So that's the fee you pay them to create the loan on top of the application and document fee.
Origination.
Sheesh.
Yeah,
It's a swindle.
yeah. So yeah, I know it's the opportunity cost, it's the access to the funds, and you know those decrease over time. They're never going to go down to zero, I don't believe, unless you have like a great relationship with that lender. But most of the times, the first time you work with a lender, you're getting a higher interest rate and higher points, and maybe I think I've also actually I know I've repeated using Carolina hard money, and they didn't charge me application fees. They charged me a lower interest rate and a lower origination fee on my subsequent loans. So that's the benefit of finding a lender, building a rhythm, building trust, and then using them again, is that they'll charge you less once you have a track record because they trust you. If that wraps it up for tonight, thank you for joining. I'll post the recording in the group and send the PowerPoint as well. And if you have any additional questions, be happy to answer. But I hope this helps you be a little bit more educated and ready to move forward on your investment. Kind of, like you said, demystify hard money loans, interchangeably called private money loans. They're not as scary as they're made out to be. Once you understand it clearly, yes, there are maybe increased fees, shorter timelines, but they afford you the ability to, really multiply your money and expand your portfolio. And that's the whole goal, to grow your wealth, to grow your cash flow, to build out your investment portfolio. So they're great tools. I've used them. I recommend them when used wisely and strategically. So I hope you all have a good night.